focus on the balance sheet, accounting practices, and unit economics, and then turn to cash flow generation. Meanwhile, the qualitative side involves reference calls to assess the quality of management and channel checks to reveal how a company's products are selling in real time. Balance sheet and accounting. While much of the analytical focus will be on the income statement, proper and thorough analysis of the balance sheet and a company's accounting are like having a solid foundation in a construction project. They are easy for a casual observer to overlook or take for granted, and may matter only once in a while. But when they matter, it's like access to oxygen. It's all that matters. In seeking to determine intrinsic values, I like to start with the concept of working inside out versus outside in. Start with facts and not opinions. If you start with opinions, it's very easy to become wedded to them even when the facts run counter to the popular narrative. Start with SEC filings, annual reports, and trade magazine articles, not with management or colleagues' narratives or sell-side reports. The biggest mistake an analyst can make in the initial stage of their research is to start their assessment by looking at earnings, or even worse, management's presentation of adjusted earnings. When you look at these reported numbers, keep in mind that you're not looking at completely objective facts so much as a management team's perception of them. The income statement is a snapshot of what has recently transpired, and this snapshot may well have been photoshopped. I want to focus on process rather than outcomes, so starting with the income statement is putting the cart before the horse. When we start with cash flow and the balance sheet, we focus on the process and understand the flow of the resources required to run the business. I like to think of the business not only in broad terms, but also in terms of its unit economics. Think in terms of a dollar or revenue that flows into a business and runs through the cash flow statement, then the balance sheet, and last, the income statement. This is ultimately how we derive a company's return on invested capital, which is usually a reliable shorthand for the quality of the business. Financial snapshots from various points in time are necessary, but not sufficient. I like to review the last 10 years and examine the changes in retained earnings, debt, and overall capital intensity as compared to the top-line growth of the business itself. I will often summarize this over 10 years in a DuPont analysis, a framework for analyzing fundamental performance popularized by the DuPont Corporation. This technique is used to decompose the different drivers of return on equity, ROE, with profit margin, asset turns, and return on assets broken out by year. It is through this kind of analysis that one can see changes in earning power over time. When companies or industries earn excess returns, it invites competition. The response to that competition can often be seen in a company's balance sheet. If a company generated $10 billion of earnings over a trailing 10-year period, but its retained earnings remained flat while debt increased significantly, earnings may have grown, but the growing leverage on the balance sheet indicates that the company may need to run harder merely to stand still. Balance sheets are also incredibly useful in identifying both funding sources and quality of earnings. We may find, for example, that a company has short-term variable rate funding rather than longer-term fixed-rate liabilities. In such a situation, the income statement may report earnings that are artificially inflated because of a risky financing decision, making the company extremely vulnerable to rising rates. A risky balance sheet, together with aggressive accounting practices, can be a recipe for disaster. I find it interesting to take two very similar companies and align their accounting practices. When I compare such factors as their expensing versus capitalizing of expenses, gain on sale accounting versus long-term holding of mortgage securities, acquisition accounting practices, and balance sheet variances, I'm often flabbergasted at the difference. The point is that earnings are a byproduct of many assumptions and choices made by management. The treatment of reserves, choice of a discount rate on contingent valuations, assumed pension returns, and method of funding lead to a result that can be either significantly overrated or underrated. The number of games that can be played here is almost limitless. These aggressive measures continue to infect the quality of earnings at American firms and are often undetected even by smart investors. Take nothing for granted. If it seems too good to be true, it probably is. Aggressive balance sheets and accounting are typically not associated with conservative management teams or those planting seeds for future generations. They are typically associated with borrowing from the future. Verifying and exploring this is the basis from which our qualitative analysis flows. Unit economics. Acquiring a thorough understanding of the balance sheet mechanics will allow us to then identify the key items on the balance sheet and drill down into them at a micro level in order to understand attributes like the unit economics of a business. Just as you can drop $1 of revenue or cost through the cash flow statement and balance sheet, you can do the same in replicating unit economics of the company. For example, looking at the earnings for Costco is one thing, examining the balance sheet another, but understanding the unit economics of an individual store is far more powerful than either of those. While the company doesn't overtly disclose store-by-store unit economics, in the case of Costco, we can use company disclosures to triangulate into the average cost to build a store. Then, by estimating the approximate time to get to run rate revenues and margins, we can approximate the individual store ROI. This calculation should reveal much about the overall business economics, but often does not, typically for one of two reasons. One, management teams often present the best possible narrative, for example, by including only variable costs and understating maintenance capital expenditures. Project or unit economic IRRs are almost always overstated for investors when they exclude important fixed costs and overstate growth capital expenditures to make the business appear better than it is. This is directly akin to relying on the undemanding metric EBITDA compared to Graham's focus on owner earnings. The second reason is that the accounting often reflects front-loaded expenses while failing to match the duration required to get to a normalized state. This was the case with the cell tower industry, some razor blade businesses, and certain retail and software businesses. American Tower was a break-even business when it had an average of 2 tenants per cell phone tower, but adding a third tenant led to extremely attractive unit economics per tower and a compelling overall ROI. Similarly, Walmart did not generate earnings or cash flow for over a decade while they were growing, but a look at the store unit economics led to the true story and foreshadowed what the picture would look like in the future. The goal is to get past management discussion or analyst reports and drill down into the business as if you were the owner. Then, and only then, can you begin connecting the dots. Keeping it simple, Principle 2. Find good management teams. The importance of good management is almost universally underestimated, yet it is one of the most crucial determinants of a company's intrinsic value. As Graham and Dodd said, you cannot make a quantitative deduction to allow for an unscrupulous management. The only way to deal with such situations is to avoid them. Chapter 33. We must recognize that businesses are composed of individuals whose decisions and judgments set the metabolism for the entire enterprise. Many analysts seem inclined to assess the quality of management based on conventional marketplace narratives about a business. One must go deeper. The way to assess management's track record is to examine their incentives, learn how they spend their time, and perform scuttlebutt research. Notice that I did not mention listening to Investor Day presentations or meeting with management. Examining a management team's track record requires a holistic, detailed, and nuanced perspective. Businesses can take a long time to either turn around or to decay. Decisions made 3, 5, and even 10 years ago are likely still impacting the bottom line today. A manager who appears to be doing a great job may, in fact, be benefiting from seeds planted many years before. Meanwhile, the economic environment in which a company operates often changes, sometimes dramatically. Just as a rising market can make any investment professional seem smarter than he or she is, persistent tailwinds can also make a corporate management team seem smarter than they are. A strength today can be a weakness tomorrow, either through ingrained fragility or simply because the competitive dynamic has shifted. Outsourcing, for example, can fatten a company's profit margins for decades until it becomes evident that it's been taken too far, and the company's basic competencies have been hollowed out. Good capital allocation is crucial. A wonderful business and a talented CEO is not enough to offset poor capital allocation. Too many companies repurchase shares above intrinsic value, pursue value-destructive mergers and acquisitions, or fail to adapt their capital allocation in response to changing conditions or emergent opportunities. Capital allocation is one of the most important parts of the track record that must be examined by prospective investors. Examine incentives. It has been said that seeing the incentives will explain the outcome. While we know that a long-term perspective is crucial in running a business, there are often unfortunate incentives to become overly short-term oriented. The private owner of a great business isn't worried about quarterly earnings, meeting market expectations, stuffing sales channels, pursuing aggressive accounting treatments, or withholding long-term investments to improve reported short-term results. To better understand management's incentives, I start with the proxy statement and look for changes year to year. Is the basis for management compensation and stock option awards sensible? Are they being measured for enduring accomplishments or instead for favorable short-term share price fluctuations that could be purely the result of luck or even manipulation? Do they reward actual returns on capital or simply profitless growth? Do they create asymmetric upside for the CEO for taking outsized risks? Is the CEO regularly selling his or her shares for personal reasons, or are they acting like a true owner and fiduciary? If the company were private, how different would the structure of the CEO's compensation and incentives be? Market pundits can focus excessively on the absolute level of management compensation rather than the context of what was required to achieve that compensation. High absolute compensation can be warranted when it rewards the achievement of demanding goals and the delivery of exceptional results. Learn how CEOs spend their time. Time management is also important. I have never met a CEO who is on the road for hundreds of days a year, meeting investors and promoting themselves or their stock, who is fully steeped in the details of their company. Ask yourself, if this were your family business, wouldn't you want your CEO single-mindedly focused on running the business? I want to back CEOs who are focused on substance, not collecting style points. Perform scuttlebutt research on CEOs. Finally, I like to speak to current and former executives who have either reported to the CEO under consideration or have had that individual report to them. This provides a good way to triangulate information. I want to go deeply into personalities in order to gain context. For example, an intense executive with an emphasis on hyper-efficiency may at some point become culturally toxic, leaving employees afraid, the company fragile, the team less than candid, and the business unable to respond to change. Intellectual honesty is also crucial in a management team. As American theoretical physicist Richard Feynman said, "You must not fool yourself, and you are the easiest person to fool." Keeping it simple, Principle 3. Finding the right price. About pricing, legendary investor and author Philip A. Fisher said, "The only true test of whether a stock is cheap or high is not its current price in relation to some former price, no matter how accustomed we may have become to that former price, but whether the company's fundamentals are significantly more or less favorable than the current financial community appraisal of that stock." Investors must deeply understand the companies behind the stock prices. The research process. Scuttlebutt research, also mentioned earlier in the chapter, is a term used by Philip A. Fisher that suggests the investor play the role of an investigative journalist, trying to get as close to the truth as possible. I've seen many investors who start their work on a potential holding by hearing a story, calling some friends to vet the story, listening to some conference calls, reading some research reports, and starting to form an opinion. The danger of this process is that it often leads to the formation of an opinion based on someone else's perception and analysis rather than your own. Instead, I start with the company's annual letters, annual reports, 10-Ks and 10-Qs, and other SEC filings, as well as trade magazine articles and press releases for the last 10 years. Has the company underpromised and overdelivered, or vice versa? Then I work my way to earnings calls, again painting a picture of whether the company does what they say they are going to do. Once I have this picture based on facts instead of a story, then like an investigative reporter, I start to develop a picture of reality. But questions remain to be answered, and it's time to do channel checks. Assessing moats. How does one go about actually assessing the depth and breadth of a business moat? Precisely what is a company's competitive advantage and how unassailable is it? Certainly, a long track record of high returns on invested capital seems like a quick and easy way to determine this. But the graveyards of capitalism are littered with companies that did, in fact, earn high ROICs for prolonged periods of time, only to ultimately succumb to competition, either directly from a more astute rival or from a changing economic landscape. An investor must get down in the weeds and conduct scuttlebutt research to ascertain whether moats around a business are strong or porous. Channel checks. Channel checks are the proverbial equivalent of gumshoe research. They entail speaking to customers, suppliers, and former employees. I always ask myself, if I were considering putting 100% of my net worth in this business, what would I want to know? Has management been laying the groundwork for the future or borrowing from it? What kind of pricing power does the business have, and has the company taken steps to maximize it, or is there slack in the system that indicates further upside? Business moats are not static and come with different characteristics. Brands, low costs, convenience, and network effects all constitute real but very different moats. This deep and detailed inside-out research serves multiple purposes. For one, it helps us gain a deep understanding of how the business actually works, as well as the quality of the moat. Two, it helps us understand the trend of the business through the primary levers, which can help us understand whether the moat is shrinking or growing. Three, it facilitates developing a dispassionate analysis based on a foundation of facts versus opinions. This helps eliminate emotions, which are the enemy of rational decision-making. After such extensive analysis, if our security falls in price following our purchase, we will likely feel more comfortable owning more of it. 4. It helps us understand the fragility or anti-fragile nature of the business, a term coined by author Nassim Nicholas Taleb to mean one that gets stronger under circumstances where others' fragility breaks them. The best businesses are anti-fragile, that is, they continue to thrive and even deepen their moats in times of adversity and volatility, such as when competitors get in trouble and their best customers and employees may be up for grabs. 5. It helps us create a base layer of understanding across many businesses and industries, which allows us to triangulate and compound our knowledge over time. This work can create mile markers of expectations and progress that we can compare and, as necessary, adjust over time. 6. There is great power to a broad-gauged approach in developing perspectives. Coming at this research with outside knowledge and perspective, combined with industry knowledge via these checks, can be a force multiplier. Performing this detailed research via filings and channel checks enables you to gain comfort in your understanding of the business. Doing thorough work enables an investor to confidently answer some really important questions. Does the business have a sustainable and/or expanding moat? What are the weakest links over the next 5 years? Are there hidden path dependencies? Does the business have pricing power, and how has it been exercised? How anti-fragile is the business, and will it thrive in the next downturn? What would it take to replicate this business? Will the business be in a better position with an even wider moat 5 years from now? If you can answer these questions with confidence, you will have clarity on the things that truly matter and be well on your way to accurately assessing intrinsic value. Remember that simple is usually better. In investing, there is no extra credit for degree of difficulty. You can find straightforward businesses with strong, sustainable moats and franchises while avoiding the axiom, when a strong management team meets a bad business, the business wins. None of this guarantees a good result, but it certainly helps. Determining intrinsic value. As Warren Buffett wrote in his 1989 letter to the Berkshire Hathaway shareholders, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." A business is worth the sum of its discounted cash flows in perpetuity. This concept sounds simple enough, but there are a few key variables involved in this calculation: the discount rate to be used and one's assessment of those cash flows in perpetuity. Estimating future cash flows entails a determination of a company's capital intensity, its growth rate, and management's allocation objectives. A couple of examples may demonstrate the power of these estimates. Assuming a constant 10% discount rate, a business that will grow at 15% a year without requiring any additional capital is worth approximately 26 times its current earnings, whereas the same business growing at 15% but needing to reinvest much or all of its earnings to achieve that growth would be worth only approximately 16 times. A business that grows at 5% and doesn't need any capital would be worth approximately 14 times its current earnings, and the same business needing all of its earnings reinvested would be worth approximately 7 times. A return of 15% compounded over 30 years is worth over 87 times the initial stake, whereas 5% compounded over the same period is worth just under 4.5 times. In this example, a threefold increase in the compound rate from 5% to 15% leads to an almost 20-fold increase in return, 87 times versus 4.5 times. This example illustrates the power of finding capital-light businesses that can grow for prolonged periods of time. Conversely, the worst business is actually one that grows and consumes increasing amounts of capital at returns that fail to exceed its cost of capital. There are, of course, businesses that require capital to grow, like a railroad, a financial institution, or retailers like Walmart or Amazon, where the returns on the newly deployed capital are perfectly acceptable. This growth capital will, over time, produce economic value. But price is paramount in determining returns. This was the great insight of Graham and Dodd. Great businesses can be terrible investments at the wrong price, and an average business can be a great investment at the right price. Fast-growing businesses can be attractive, but only at the right price. In recent years, during long periods of low interest rates, many investors flocked to growth at all costs under the simple and flawed formula of earnings yield plus growth rate. Because price is key, one must additionally adjust the growth rate by comparing today's price relative to a company's intrinsic value. The value of the growth is diminished because you've paid a significant price for it up front. The market has historically traded around a 15 times earnings multiple, which equates to a 6.7% earnings yield. If you can find a better-than-average business with better-than-average management for less than this earnings multiple, it is likely a good start. Graham and Dodd called this a margin of safety. There are two other considerations. One is to be sure to consider owner earnings and not EBITDA, or even the more pernicious adjusted EBITDA. Owner earnings is defined as unadjusted reported earnings, plus depreciation, amortization, and certain other non-cash charges, less average annual maintenance capex required to fully maintain its competitive position. The other is the need to look at the entire corporate capital structure. Companies that are over-levered can experience large changes in their equity valuations with only the slightest change to owner earnings. Investors who look at a stock without incorporating the complete capitalization picture can miss a key component because equity values are contingent, while debt is forever. The final product, what matters? Human beings constantly process complex information about the world and simplify it to make sense of it and put it into context. This allows us to make decisions. I go outside in the morning and I look at my car, an intricate and complex network of metal parts and functions, but I simply process it as a thing called car and drive off to my job. Easy, right? But for whatever reason, investors tend to complexify a concept. In my own case, I am convinced following the process I've described allows me to get closest to the reality of what's in front of me, and the realities of intrinsic values and margins of safety are critical in investing. For example, I ask myself, what business is the company really in? What are the key drivers that will determine its success? I'm now in a unique position of serving in two roles, as both the CEO of Geico and, in my responsibility, investing a substantial portfolio pool of capital at Berkshire Hathaway. Each of these roles impacts the other. My CEO role makes me more aware of the key challenges facing a CEO, the constant balancing act between short-term exigencies and long-term imperatives. As a CEO, I'm intensely aware of the dangerous oversimplification inherent in a spreadsheet. But being an investor maintains my focus on both risk and on return. A CEO can be lost in the daily minutia. Wearing an investment hat places a consistent emphasis on the bottom line. Warren Buffett has famously stated, "I am a better investor because I am a businessman, and a better businessman because I am an investor." Investors attempt to look behind the curtain of a company's operations, but they often realize how little they actually know. From this vantage point, one can appreciate that even extensive research will uncover only a small fraction of what one can possibly know about a business. Investors must find a way to navigate through uncertainty and randomness. There are decisions being made every day, and sometimes made decades earlier, that are still affecting outcomes today in every business and industry. There are intricate path dependencies that are often too complex even for very skilled upper management to fully understand the trade-offs involved. Perfect information does not exist. There are only confidence intervals. This is, of course, at the heart of why a margin of safety matters so greatly in investing. If you start with the premise that there is only so much one can know, of course you need a margin for error. The less you know, the greater the margin needed. Chapter 27. The Theory of Common Stock Investment. In our introductory discussion, we set forth the difficulties inherent in efforts to apply the analytical technique to speculative situations. Since the speculative factors bulk particularly large in common stocks, it follows that analysis of such issues is likely to prove inconclusive and unsatisfactory, and even where it appears to be conclusive, there is danger that it may be misleading. At this point, it is necessary to consider the function of common stock analysis in greater detail. We must begin with three realistic premises. The first is that common stocks are of basic importance in our financial scheme and of fascinating interest to many people. The second is that owners and buyers of common stocks are generally anxious to arrive at an intelligent idea of their value. The third is that, even when the underlying motive of purchase is mere speculative greed, human nature desires to conceal this unlovely impulse behind a screen of apparent logic and good sense. To adapt the aphorism of Voltaire, it may be said that if there were no such thing as common stock analysis, it would be necessary to counterfeit it. Broad merits of common stock analysis. We are thus led to the question, to what extent is common stock analysis a valid and truly valuable exercise, and to what extent is it an empty but indispensable ceremony attending the wagering of money on the future of business and of the stock market? We shall ultimately find the answer to run somewhat as follows. As far as the typical common stock is concerned, an issue picked at random from the list, an analysis, however elaborate, is unlikely to yield a dependable conclusion as to its attractiveness or its real value. But in individual cases, the exhibit may be such as to permit reasonably confident conclusions to be drawn from the processes of analysis. It would follow that analysis is of positive or scientific value only in the case of exceptional common stock, and that for common stocks in general, it must be regarded either as a somewhat questionable aid to speculative judgment or as a highly illusory method of aiming at values that defy calculation and that must somehow be calculated nonetheless. Perhaps the most effective way of clarifying the subject is through the historical approach. Such a survey will throw light not only upon the changing status of common stock analysis, but also upon a closely related subject of major importance, viz., the theory of common stock investment. We shall encounter at first a set of old established and seemingly logical principles for common stock investment. Through the advent of new conditions, we shall find the validity of these principles impaired. Their insufficiency will give rise to an entirely different concept of common stock selection, the so-called New Era theory, which beneath its superficial plausibility will hold possibilities of untold mischief in store. With the pre-war theory obsolete and the New Era theory exploded, we must finally make the attempt to establish a new set of logically sound and reasonably dependable principles of common stock investment. History of common stock analysis. Turning first to the history of common stock analysis, we shall find that two conflicting factors have been at work during the past 30 years. On the one hand, there has been an increase in the investment prestige of common stocks as a class, due chiefly to the enlarged number that have shown substantial earnings, continued dividends, and a strong financial condition. Accompanying this progress was a considerable advance in the frequency and adequacy of corporate statements, thus supplying the public and the securities analyst with a wealth of statistical data. Finally, an impressive theory was constructed asserting the preeminence of common stocks as long-term investments. But at the time that the interest in common stocks reached its height, in the period between 1927 and 1929, the basis of valuation employed by the stock-buying public departed more and more from the factual approach and technique of security analysis and concerned itself increasingly with the elements of potentiality and prophecy. Moreover, the heightened instability in the affairs of industrial companies and groups of enterprises, which has undermined the investment quality of bonds in general, has of course been still more hostile to the maintenance and true investment quality in common stocks. Analysis vitiated by two types of instability. The extent to which common stock analysis has been vitiated by these two developments, 1. The instability of tangibles, and 2. The dominant importance of intangibles, may be better realized by a contrast of specific common stocks prior to 1920 and in more recent times. Let us consider four typical examples: Pennsylvania Railroad, Atchison, Topeka, and Santa Fe Railway, National Biscuit, and American Can. Charts for these examples may be found in the accompanying PDF. American Can was a typical example of a pre-war speculative stock. It was speculative for three good and sufficient reasons. 1. It paid no dividend. 2. Its earnings were small and irregular. 3. The issue was watered. That is, a substantial part of its stated value represented no actual investment in the business. By contrast, Pennsylvania, Atchison, and National Biscuit were regarded as investment common stocks, also for three good and sufficient reasons. 1. They showed a satisfactory record of continued dividends. 2. The earnings were reasonably stable and averaged substantially in excess of the dividends paid. And 3. Each dollar of stock was backed by $1 or more of actual investment in the business. If we study the range of market prices of these issues during the decade preceding the World War, or the 1909 to 1918 period for National Biscuit, we note that American Can fluctuated widely from year to year in the fashion regularly associated with speculative media, but that Pennsylvania, Atchison, and National Biscuit showed much narrower variations and evidently tended to oscillate about a base price. That is, 97 for Atchison, 64 for Pennsylvania, and 120 for National Biscuit, that seem to represent a well-defined view of their investment or intrinsic value. Pre-war conception of investment in common stocks. Hence, the pre-war relationship between analysis and investment on the one hand and price changes and speculation on the other may be set forth as follows. Investment in common stocks was confined to those showing stable dividends and fairly stable earnings, and such issues in turn were expected to maintain a fairly stable market level. The function of analysis was primarily to search for elements of weakness in the picture. If the earnings were not properly stated, if the balance sheet revealed a poor current position, or the funded debt was growing too rapidly, if the physical plant was not properly maintained, if dangerous new competition was threatening, or if the company was losing ground in the industry, if the management was deteriorating or was likely to change for the worse, if there was reason to fear for the future of the industry as a whole, any of these defects or some other one might be sufficient to condemn the issue from the standpoint of the cautious investor. On the positive side, analysis was concerned with finding those issues which met all the requirements of investment and, in addition, offered the best chance for future enhancement. The process was largely a matter of comparing similar issues in the investment class, for example, the group of dividend-paying Northwestern railroads. Chief emphasis would be laid upon the relative showing for past years, in particular the average earnings in relation to price and the stability and the trend of earnings. To a lesser extent, the analyst sought to look into the future and to select the industries or the individual companies that were likely to show the most rapid growth. Speculation characterized by emphasis on future prospects. In the pre-war period, it was the well-considered view that when prime emphasis was laid upon what was expected of the future, instead of what had been accomplished in the past, a speculative attitude was thereby taken. Speculation, in its etymology, meant looking forward. Investment was allied to vested interests, to property rights and values taking root in the past. The future was uncertain, therefore speculative. The past was known, therefore the source of safety. Let us consider a buyer of American Can Common in 1910. He may have bought it believing that its price was going to advance or be put up, or that its earnings were going to increase, or that it was soon going to pay a dividend, or possibly that it was destined to develop into one of the country's strongest industrials. From the pre-war standpoint, although one of these reasons may have been more intelligent or creditable than another, each of them constituted a speculative motive for the purchase. Technique of investing in common stocks resembled that for bonds. Evidently, there was a close similarity between the technique of investing in common stocks and that of investing in bonds. The common stock investor also wanted a stable business and one showing an adequate margin of earnings over dividend requirements. Naturally, he had to content himself with a smaller margin of safety than he would demand of a bond, a disadvantage that was offset by a larger income return. 6% was standard on a good common stock, compared with 4.5% on a high-grade bond. By the chance of an increased dividend if the business continued to prosper, and generally of least importance in his eyes by the possibility of a profit. A common stock investor was likely to consider himself as in no very different position from that of a purchaser of second-grade bonds. Essentially, his venture amounted to sacrificing a certain degree of safety in return for larger income. The Pennsylvania and Atchison examples during the 1904 to 1913 decade will supply specific confirmation of the foregoing description. Buying common stocks viewed as taking a share in a business. Another useful approach to the attitude of the pre-war common stock investor is from the standpoint of taking an interest in a private business. The typical common stock investor was a businessman, and it seemed sensible to him to value any corporate enterprise in much the same manner as he would value his own business. This meant that he gave at least as much attention to the asset values behind the shares as he did to their earnings records. It is essential to bear in mind the fact that a private business has always been valued primarily on the basis of the net worth as shown by its statement. A man contemplating the purchase of a partnership or stock interest in a private undertaking will always start with the value of that interest as shown on the books, that is, the balance sheet, and will then consider whether or not the record and prospects are good enough to make such a commitment attractive. An interest in a private business may of course be sold for more or less than its proportionate asset value, but the book value is still invariably the starting point of the calculation, and the deal is finally made and viewed in terms of the premium or discount from book value involved. Broadly speaking, the same attitude was formerly taken in an investment purchase of a marketable common stock. The first point of departure was the par value, presumably representing the amount of cash or property originally paid into the business. The second basal figure was the book value, representing the par value plus a ratable interest in the accumulated surplus. Hence, in considering a common stock, investors asked themselves, is this issue a desirable purchase at the premium above book value or the discount below book value represented by the market price? Watered stock was repeatedly inveighed against as a deception practiced upon the stock-buying public, who were misled by a fictitious statement of the asset values existing behind the shares. Hence, one of the protective functions of security analysis was to discover whether or not the value of the fixed assets, as stated on the balance sheet of a company, fairly represented the actual cost or reasonable worth of the properties. Investment in common stocks based on threefold concept. We thus see that investment in common stocks was formerly based upon the threefold concept of 1. A suitable and established dividend return, 2. A stable and adequate earnings record, and 3. A satisfactory backing of tangible assets. Each of these three elements could be made the subject of careful analytical study, viewing the issue both by itself and in comparison with others of its class. Common stock commitments motivated by any other viewpoint were characterized as speculative, and it was not expected that they should be justified by a serious analysis. The New Era Theory. During the post-war period, and particularly during the latter stage of the bull market culminating in 1929, the public acquired a completely different attitude towards the investment merits of common stocks. Two of the three elements above stated lost nearly all their significance, and the third, the earnings record, took on an entirely novel complexion. The new theory or principle may be summed up in the sentence, the value of a common stock depends entirely upon what it will earn in the future. From this dictum, the following corollaries were drawn. 1. That the dividend rate should have slight bearing upon the value. 2. That since no relationship apparently existed between assets and earning power, the asset value was entirely devoid of importance. 3. That past earnings were significant only to the extent that they indicated what changes in the earnings were likely to take place in the future. This complete revolution in the philosophy of common stock investment took place virtually without realization by the stock-buying public and with only the most superficial recognition by financial observers. An effort must be made to reach a thorough comprehension of what this changed viewpoint really signifies. To do so, we must consider it from three angles: its causes, its consequences, and its logical validity. Causes for this changed viewpoint. Why did the investing public turn its attention from dividends, from asset values, and from average earnings to transfer it almost exclusively to the earnings trend, that is, to the changes in earnings expected in the future? The answer was, first, that the records of the past were proving an undependable guide to investment, and second, that the rewards offered by the future had become irresistibly alluring. The new era concepts had their root, first of all, in the obsolescence of the old established standards. During the last generation, the tempo of economic change has been speeded up to such a degree that the fact of being long established has ceased to be, as once it was, a warranty of stability. Corporations enjoying decade-long prosperity have been precipitated into insolvency within a few years. Other enterprises which had been small or unsuccessful or in doubtful repute have just as quickly acquired dominant size, impressive earnings, and the highest rating. The major group upon which investment interest was chiefly concentrated, viz., the railroads, failed signally to participate in the expansion of national wealth and income and showed repeated signs of definite retrogression. The street railways, another important medium of investment prior to 1914, rapidly lost the greater portion of their value as the result of the development of new transportation agencies. The electric and gas companies followed an irregular course during this period, since they were harmed rather than helped by the war and post-war inflation, and their impressive growth was a relatively recent phenomenon. The history of industrial companies was a hodgepodge of violent changes in which the benefits of prosperity were so unequally and so impermanently distributed as to bring about the most unexpected failures alongside of the most dazzling successes. In the face of all this instability, it was inevitable that the threefold basis of common stock investment should prove totally inadequate. Past earnings and dividends could no longer be considered, in themselves, an index of future earnings and dividends. Furthermore, these future earnings showed no tendency whatever to be controlled by the amount of the actual investment in the business, the asset values, but instead depended entirely upon a favorable industrial position and upon capable or fortunate managerial policies. In numerous cases of receivership, the current assets dwindled, and the fixed assets proved almost worthless. Because of this absence of any connection between both assets and earnings, and between assets and realizable values in bankruptcy, less and less attention came to be paid either by financial writers or by the general public to the formerly important question of net worth or book value. And it may be said that by 1929 book value had practically disappeared as an element in determining the attractiveness of a security issue. It is a significant confirmation of this point that watered stock, once so burning an issue, is now a forgotten phrase. Attention shifted to the trend of earnings. Thus, the pre-war approach to investment based upon past records and tangible facts became outworn and was discarded. Could anything be put in its place? A new conception was given central importance, that of trend of earnings. The past was important only insofar as it showed the direction in which the future could be expected to move. A continuous increase in profits proved that the company was on the upgrade and promised still better results in the future than had been accomplished to date. Conversely, if the earnings had declined or even remained stationary during a prosperous period, the future must be thought unpromising, and the issue was certainly to be avoided. The common stocks as long-term investments doctrine. Along with this idea as to what constituted the basis for common stock selection emerged a companion theory that common stocks represented the most profitable and therefore the most desirable media for long-term investment. This gospel was based upon a certain amount of research showing that diversified lists of common stocks had regularly increased in value over stated intervals of time for many years past. The figures indicated that such diversified common stock holdings yielded both a higher income return and a greater principal profit than purchases of standard bonds. The combination of these two ideas supplied the investment theory upon which the 1927 to 1929 stock market proceeded. Amplifying the principle stated earlier in this chapter, the theory ran as follows. 1. The value of a common stock depends on what it can earn in the future. 2. Good common stocks are those which have shown a rising trend of earnings. 3. Good common stocks will prove sound and profitable investments. These statements sound innocent and plausible, yet they concealed two theoretical weaknesses that could and did result in untold mischief. The first of these defects was that they abolished the fundamental distinctions between investment and speculation. The second was that they ignored the price of a stock in determining whether or not it was a desirable purchase. New era investment equivalent to pre-war speculation. A moment's thought will show that new era investment as practiced by the public and the investment trusts was almost identical with speculation as popularly defined in pre-boom days. Such investment meant buying common stocks instead of bonds, emphasizing enhancement of principal instead of income, and stressing the changes of the future instead of the facts of the established past. It would not be inaccurate to state that new era investment was simply old-style speculation confined to common stocks with a satisfactory trend of earnings. The impressive new concept underlying the greatest stock market boom in history appears to be no more than a thinly disguised version of the old cynical epigram, "Investment is successful speculation." Stocks regarded as attractive irrespective of their prices. The notion that the desirability of a common stock was entirely independent of its price seems incredibly absurd. Yet the new era theory led directly to this thesis. If a public utility stock was selling at 35 times its maximum recorded earnings instead of 10 times its average earnings, which was the pre-boom standard, the conclusion to be drawn was not that the stock was now too high, but merely that the standard of value had been raised. Instead of judging the market price by established standards of value, the new era based its standards of value upon the market price. Hence, all upper limits disappeared not only upon the price at which a stock could sell, but even upon the price at which it would deserve to sell. This fantastic reasoning actually led to the purchase of $100 per share of common stocks earning $2.50 per share. The identical reasoning would support the purchase of these same shares at $200, at $1,000, or at any conceivable price. An alluring corollary of this principle was that making money in the stock market was now the easiest thing in the world. It was only necessary to buy good stocks regardless of price, and then to let nature take her upward course. The results of such a doctrine could not fail to be tragic. Countless people asked themselves, why work for a living when a fortune can be made in Wall Street without working? The ensuing migration from business into the financial district resembled the famous gold rush to the Klondike, except that gold was brought to Wall Street instead of taken from it. Investment trusts adopted this new doctrine. An ironical sidelight is thrown on this 1928 to 1929 theory by the practice of the investment trusts. These were formed for the purpose of giving the untrained public the benefit of expert administration of its funds, a plausible idea and one that had been working reasonably well in England. The earliest American investment trusts laid considerable emphasis upon certain time-tried principles of successful investment, which they were much better qualified to follow than the typical individual. The most important of these principles were: 1. To buy in times of depression and low prices, and to sell out in times of prosperity and high prices. 2. To diversify holdings in many fields and probably in many countries. 3. To discover and acquire undervalued individual securities as the result of comprehensive and expert statistical investigations. The rapidity and completeness with which these traditional principles disappeared from investment trust technique is one of the many marvels of the period. The idea of buying in times of depression was obviously inapplicable. It suffered from the fatal weakness that investment trusts could be organized only in good times, so that they were virtually compelled to make their initial commitments in bull markets. The idea of worldwide geographical distribution had never exerted a powerful appeal upon the provincially minded Americans, who possibly were right in this respect, and with things going so much better here than abroad, this principle was dropped by common consent. Analysis abandoned by investment trusts. But most paradoxical was the early abandonment of research and analysis in guiding investment trust policies. However, since these financial institutions owed their existence to the new era philosophy, it was natural and perhaps only just that they should adhere closely to it. Under its canons, investment had now become so beautifully simple that research was unnecessary and elaborate statistical data a mere encumbrance. The investment process consisted merely of finding prominent companies with a rising trend of earnings and then buying their shares regardless of price. Hence, the sound policy was to buy only what everyone else was buying, a select list of highly popular and exceedingly expensive issues, appropriately known as the blue chips. The original idea of searching for the undervalued and neglected issues dropped completely out of sight. Investment trusts actually boasted that their portfolios consisted exclusively of the active and standard, that is, the most popular and highest priced, common stocks. With but slight exaggeration, it might be asserted that under this convenient technique of investment, the affairs of a $10 million investment trust could be administered by the intelligence, the training, and the actual labors of a single $30 a week clerk. The man in the street, having been urged to entrust his funds to the superior skill of investment experts for substantial compensation, was soon reassuringly told that the trust would be careful to buy nothing except what the man in the street was buying himself. The justification offered. Irrationality could go no further. Yet it is important to note that mass speculation can flourish only in such an atmosphere of illogic and unreality. The self-deception of the mass speculator must, however, have its element of justification. This is usually some generalized statement, sound enough within its proper field, but twisted to fit the speculative mania. In real estate booms, the reasoning is usually based upon the inherent permanence and growth of land values. In the New Era bull market, the rational basis was the record of long-term improvement shown by diversified common stock holdings. A sound premise used to support an unsound conclusion. There was, however, a radical fallacy involved in the New Era application of this historical fact. This should be apparent from even a superficial examination of the data contained in the small and rather sketchy volume from which the New Era theory may be said to have sprung. The book is entitled Common Stocks as Long-Term Investments by Edgar Lawrence Smith, published in 1924. Common stocks were shown to have a tendency to increase in value with the years, for the simple reason that they earned more than they paid out in dividends, and thus the reinvested earnings added to their worth. In a representative case, the company would earn an average of 9%, pay 6% in dividends, and add 3% to surplus. With good management and reasonable luck, the fair value of the stock would increase with its book value at the annual rate of 3% compounded. This was, of course, a theoretical rather than a standard pattern, but the numerous instances of results poorer than normal might be offset by examples of more rapid growth. The attractiveness of common stocks for the long pull thus lay essentially in the fact that they earned more than the bond interest rate upon their cost. This would be true typically of a stock earning $10 and selling at $100. But as soon as the price was advanced to a much higher price in relation to earnings, this advantage disappeared, and with it disappeared the entire theoretical basis for investment purchases of common stocks. When in 1929 investors paid $200 per share for a stock earning $8, they were buying an earning power no greater than the bond interest rate without the extra protection afforded by a prior claim. Hence, in using the past performances of common stocks as the reason for paying prices 20 to 40 times their earnings, the New Era exponents were starting with a sound premise and twisting it into a woefully unsound conclusion. In fact, their rush to take advantage of the inherent attractiveness of common stocks itself produced conditions entirely different from those which had given rise to this attractiveness and upon which it basically depended, viz., the fact that earnings had averaged some 10% on market price. As we have seen, Edgar Lawrence Smith plausibly explained the growth of common stock values as arising from the building up of asset values through the reinvestment of surplus earnings. Paradoxically enough, the New Era theory that exploited this finding refused to accord the slightest importance to the asset values behind the stocks it favored. Furthermore, the validity of Mr. Smith's conclusions rested necessarily upon the assumption that common stocks could be counted on to behave in the future about as they had in the past. Yet the new era theory threw out of account the past earnings of corporations except insofar as they were regarded as pointing to a trend for the future. Examples showing emphasis on trend of earnings. Take 3 companies with the following exhibits, which may be found in the accompanying PDF. The 1929 high prices for these 3 companies show that the new era attitude was enthusiastically favorable to Company A, unimpressed by Company B, and definitely hostile to Company C. The market considered Company A shares worth more than twice as much as Company C shares, although the latter earned 50% more per share than Company A in 1929, and its average earnings were 150% greater. Average versus trend of earnings. These relationships between price and earnings in 1929 show definitely that the past exhibit was no longer a measure of normal earning power, but merely a weather vane to show which way the winds of profit were blowing. That the average earnings had ceased to be a dependable measure of future earnings must indeed be admitted, because of the greater instability of the typical business to which we have previously alluded. But it did not follow at all that the trend of earnings must therefore be a more dependable guide than the average, and even if it were more dependable, it would not necessarily provide a safe basis entirely by itself for investment. The accepted assumption that because earnings have moved in a certain direction for some years past, they will continue to move in that direction is fundamentally no different from the discarded assumption that because earnings averaged a certain amount in the past, they will continue to average about that amount in the future. It may well be that the earnings trend offers a more dependable clue to the future than does the earnings average, but at best, such an indication of future results is far from certain. And, more important still, there is no method of establishing a logical relationship between trend and price. This means that the value placed upon a satisfactory trend must be wholly arbitrary and hence speculative and hence inevitably subject to exaggeration and later collapse. Danger in projecting trends into the future. There are several reasons why we cannot be sure that a trend of profits shown in the past will continue in the future. In the broad economic sense, there is the law of diminishing returns and of increasing competition, which must finally flatten out any sharply upward curve of growth. There is also the flow and ebb of the business cycle, from which the particular danger arises that the earnings curve will look most impressive on the very eve of a serious setback. Considering the 1927 to 1929 period, we observe that since the trend of earnings theory was, at bottom, only a pretext to excuse rank speculation under the guise of investment, the profit-mad public was quite willing to accept the flimsiest evidence of the existence of a favorable trend. Rising earnings for a period of 5 or 4 or even 3 years only were regarded as an assurance of uninterrupted future growth and a warrant for projecting the curve of profits indefinitely upward. Example: the prevalent heedlessness on this score was most evident in connection with the numerous common stock flotations during this period. The craze for a showing of rising profits resulted in the promotion of many industrial enterprises that had been favored by temporary good fortune and were just approaching or had already reached the peak of their prosperity. A typical example of this practice is found in the offering of preferred and common stock of Schletter and Zander, Inc., a manufacturer of hosiery, name changed later to Signature Hosiery Company. The company was organized in 1929 to succeed a company organized in 1922, and the financing was effected by the sale of 44,810 shares of $3.50 convertible preferred shares at $50 per share and 261,349 voting trust certificates for common stock at $26 per share. The offering circular presented the following exhibit of earnings from the constituent properties. These may be seen in the accompanying PDF. In 1931, liquidation of the company's assets was begun, and a total of $17 per share in liquidating dividends on the preferred had been paid up to the end of 1933. Assets then remaining for liquidation were negligible. The common was wiped out. This example illustrates one of the paradoxes of financial history, viz., that at the very period when the increasing instability of individual companies had made the purchase of common stocks far more precarious than before, the gospel of common stocks as safe and satisfactory investments was preached to and avidly accepted by the American public. Chapter 28. Newer Canons of Common Stock Investment. Our extended discussion of the theory of common stock investment has thus far led only to negative conclusions. The older approach, centering upon the conception of a stable average earning power, appears to have been vitiated by the increasing instability of the typical business. As for the new era view, which turned upon the earnings trend as the sole criterion of value, whatever truth may lurk in this generalization, its blind adoption as a basis for common stock purchases, without calculation or restraint, was certain to end in an appalling debacle. Is there anything at all left, then, of the idea of sound investment in common stocks? A careful review of the preceding criticism will show that it need not be so destructive to the notion of investment in common stocks as a first impression would suggest. The instability of individual companies may conceivably be offset by means of thoroughgoing diversification. Moreover, the trend of earnings, although most dangerous as a sole basis for selection, may prove a useful indication of investment merit. If this approach is a sound one, there may be formulated an acceptable canon of common stock investment containing the following elements. 1. Investment is conceived as a group operation in which diversification of risk is depended upon to yield a favorable average result. 2. The individual issues are selected by means of qualitative and quantitative tests corresponding to those employed in the choice of fixed value investments. 3. A greater effort is made than in the case of bond selection to determine the future outlook of the issues considered. Whether or not a policy of common stock acquisition based upon the foregoing principles deserves the title of investment is undoubtedly open to debate. The importance of the question and the lack of well-defined and authoritative views thereon compel us to weigh here the leading arguments for and against this proposition. 3 general approaches. Secular expansion as basis. May the ownership of a carefully selected, diversified group of common stocks purchased at reasonable prices be characterized as a sound investment policy? An affirmative answer may be developed from any one of 3 different kinds of assumptions relating to the future of American business and the policy of selection that is followed. The first will posit that certain basic and long-established elements in this country's economic experience may still be counted upon. These are, 1. That our national wealth and earning power will increase. 2. That such increase will reflect itself in the increased resources and profits of our important corporations. And 3. That such increases will, in the main, take place through the normal process of investment of new capital and reinvestment of undistributed earnings. The third part of this assumption signifies that a broad causal connection exists between accumulating surplus and future earning power, so that common stock selection is not a matter purely of chance or guesswork, but should be governed by an analysis of past records in relation to current market prices. If these fundamental conditions still obtain, then common stocks with suitable exhibits should on the whole present the same favorable opportunities in the future as they have for generations past. The cardinal defect of instability may not be regarded, therefore, as menacing the long-range development of common stocks as a whole. It does indeed exert a powerful temporary effect upon all business through the variations of the economic cycle, and it has permanently adverse effects upon individual enterprises and single industries. But of these two dangers, the latter may be offset in part by careful selection and chiefly by wide diversification. The former may be guarded against by unvarying insistence upon the reasonableness of the price paid for each purchase. They would be rash authors who would express themselves unequivocally for or against this basic assumption that American business will develop in the future pretty much as in the past. In our introduction, we point out that the experience of the last 15 years weighs against this proposition. Without seeking to prophesy the future, may it not suffice to declare that the investor cannot safely rely upon a general growth of earnings to provide both safety and profit over the long pull? In this respect, it would seem that we are back to the investor's attitude in 1913, with the difference that his caution then seemed needlessly blind to the powerful evidences of secular growth inherent in our economy. Our caution today would appear, at least, to be based on bitter experience and on the recognition of some newer and less promising factors in the whole business picture. Individual growth as basis of selection. Those who would reject the suggestion that common stock investment may be founded securely on a general secular expansion may be attracted to a second approach. This stresses the element of selectivity and is based on the premise that certain favored companies may be relied on to grow steadily. Hence, such companies, when located, can be bought with confidence as long-term investments. This philosophy of investment is set forth at some length in the 1938 report of National Investors Corporation, an investment trust from which we quote as follows. The studies by this organization, directed specifically toward improved procedure in selection, afford evidence that the common stocks of growth companies, that is, companies whose earnings move forward from cycle to cycle and are only temporarily interrupted by periodic business depressions, offer the most effective medium of investment in the field of common stocks, either in terms of dividend return or longer-term capital appreciation. We believe that this general conclusion can be demonstrated statistically and is supported by economic analysis and practical reasoning. In considering this statement critically, we must start with the emphatic but rather obvious assertion that the investor who can successfully identify such growth companies when their shares are available at reasonable prices is certain to do superlatively well with his capital. Nor can it be denied that there have been investors capable of making such selections with a high degree of accuracy, and that they have benefited hugely from their foresight and good judgment. But the real question is whether or not all careful and intelligent investors can follow this policy with fair success. 3 aspects of the problem. Actually, the problem falls into 3 parts. First, what is meant by a growth company? Second, can the investor identify such concerns with reasonable accuracy? Third, to what extent does the price paid for such stocks affect the success of the program? 1. What are growth companies? The National Investors Corporation discussion defined growth companies as those whose earnings move forward from cycle to cycle. How many cycles are needed to meet this definition? The fact of the matter seems to be that prior to 1930, a large proportion of all publicly owned American businesses grew from cycle to cycle. The distinguishing characteristic of growth companies, as now understood, developed only in the period between 1929 and 1936 to 1937. In this one cycle, we find that most companies failed to regain their full depression losses. The minority that did so stand out from the rest, and it is these which are now given the complimentary title of growth companies. But since this distinction is in reality based on performance during a single cycle, how sure can the investor be that it will be maintained over the longer future? It is true from what we have previously said that many of the companies that expanded from 1929 to 1937 had participated in the general record of growth prior to 1929, so that they combined the advantages of a long period of upbuilding and an exceptional ability to expand in the last decade. The following are examples of large and well-known companies of this class. Air Reduction, Alice Chalmers, Coca-Cola, Commercial Credit, Dow Chemical, DuPont, International Business Machines, International Nickel, Libby Owens Ford, Monsanto Chemical, Owens Illinois Glass, J.C. Penney, Procter & Gamble, Sherwin-Williams Paint, Standard Oil of New Jersey, Scott Paper, Union Carbide, and Carbon. 2. Can the investor identify them? But our natural enthusiasm for such excellent records is tempered somewhat by a sobering consideration. This is the fact that, viewed historically, most successful companies of the past are found to have pursued a well-defined life cycle, consisting first of a series of struggles and setbacks, second, of a halcyon period of prosperity and persistent growth, which in turn passes over into a final phase of supermaturity, characterized by a slackening of expansion and perhaps an actual loss of leadership or even profitability. It follows that a business that has enjoyed a very long period of increasing earnings may, ipso facto, be nearing its own saturation point. Hence, the seeker for growth stocks really faces a dilemma. For if he chooses newer companies with a short record of expansion, he runs the risk of being deceived by a temporary prosperity. And if he chooses enterprises that have advanced through several business cycles, he may find this apparent strength to be the harbinger of coming weakness. We see, therefore, that the identification of a growth company is not so simple a matter as it may at first appear. It cannot be accomplished solely by an examination of the statistics and records, but requires a considerable supplement of special investigation and of business judgment. Proponents of the growth company principle of investment are wont currently to lay great emphasis on the element of industrial research. In the absence of general business expansion, exceptional gains are likely to be made by companies supplying new products or processes. These in turn are likely to emerge from research laboratories. The profits realized from cellophane, ethyl gas, and various plastics, and from advances in the arts of radio, photography, refrigeration, aeronautics, etc., have created a natural enthusiasm for research as a business asset and a natural tendency to consider the possession of research facilities as the sine qua non of industrial progress. Still, here too caution is needed. If the mere ownership of a research laboratory could guarantee a successful future, every company in the land would have one. Hence, the investor must pay heed to the kind of facilities owned, the abilities of the researchers, and the potentialities of the field under investigation. It is not impossible to study these points successfully, but the task is not easy, and the chance of error is great. 3. Does the price discount potential growth? The third source of difficulty is perhaps the greatest. Assuming a fair degree of confidence on the part of the investor that the company will expand in the future, what price is he justified in paying for this attractive element? Obviously, if he can get a good future for nothing, that is, if the price reflects only the past record, he is making a sound investment. But this is not the case, of course, if the market itself is counting on future growth. Characteristically, stocks thought to have good prospects sell at relatively high prices. How can the investor tell whether or not the price is too high? We think that there is no good answer to this question. In fact, we are inclined to think that even if one knew for a certainty just what a company is fated to earn over a long period of years, it would still be impossible to tell what is a fair price to pay for it today. It follows that once the investor pays a substantial amount for the growth factor, he is inevitably assuming certain kinds of risk, viz., that the growth will be less than he anticipates, that over the long pull he will have paid too much for what he gets, that for a considerable period the market will value the stock less optimistically than he does. On the other hand, assume that the investor strives to avoid paying a high premium for future prospects by choosing companies about which he is personally optimistic, although they are not favorites of the stock market. No doubt this is the type of judgment that, if sound, will prove most remunerative. But by the very nature of the case, it must represent the activity of strong-minded and daring individuals rather than investment in accordance with accepted rules and standards. May such purchases be described as investment commitments? This has been a longish discussion because the subject is important and not too well comprehended in Wall Street. Our emphasis has been laid more on the pitfalls of investing for future growth than on its advantages. But we repeat that this method may be followed successfully if it is pursued with skill, intelligence, and diligent study. If so, is it appropriate to call such purchases by the name of investment? Our answer is yes, provided that two factors are present. The first, already mentioned, that the elements affecting the future are examined with real care and a wholesome skepticism, rather than accepted quickly via some easy generalization. The second, that the price paid be not substantially different from what a prudent businessman would be willing to pay for a similar opportunity presented to him to invest in a private undertaking over which he could exercise control. We believe that the second criterion will supply a useful touchstone to determine whether the buyer is making a well-considered and legitimate commitment in an enterprise with an attractive future, or instead, under the guise of investment, he is really taking a flyer in a popular stock or else letting his private enthusiasm run away with his judgment. It will be argued, perhaps, that common stock investments such as we have been discussing may properly be made at a considerably higher price than would be justified in the case of a private business, first because of the great advantage of marketability that attaches to listed stocks, and second, because the large size and financial power of publicly owned companies make them inherently more attractive than any private enterprise could be. As to the second point, the price to be paid should suitably reflect any advantages accruing by reason of size and financial strength. But this criterion does not really depend on whether the company is publicly or privately owned. On the first point, there is room for some difference of opinion whether or not the ability to control a private business affords a full counterweight in value analysis to the advantage of marketability enjoyed by a listed stock. To those who believe marketability is more valuable than control, we might suggest that in any event the premium to be paid for this advantage cannot well be placed above, say, 20% of the value otherwise justified without danger of introducing a definitely speculative element into the picture. Selection based on margin of safety principle. The third approach to common stock investment is based on the margin of safety principle. If the analyst is convinced that a stock is worth more than he pays for it, and if he is reasonably optimistic as to the company's future, he would regard the issue as a suitable component of a group investment in common stocks. This attack on the problem lends itself to two possible techniques. One is to buy at times when the general market is low, measured by quantitative standards of value. Presumably, the purchases would then be confined to representative and fairly active issues. The other technique would be employed to discover undervalued individual common stocks, which presumably are available even when the general market is not particularly low. In either case, the margin of safety resides in the discount at which the stock is selling below its minimum intrinsic value as measured by the analyst. But with respect to the hazards and the psychological factors involved, the two approaches differ considerably. Let us discuss them in their order. Factors complicating efforts to exploit general market swings. A glance at the chart on page 6, which may be found in the accompanying PDF, showing the fluctuations of common stock prices since 1900, would suggest that prices are recurrently too high and too low, and that consequently there should be repeated opportunities to buy stocks at less than their value and to sell them out later at fair value or higher. A crude method of doing this, but one apparently encouraged by the chart itself, would consist simply of drawing a straight line through the approximate midpoints of past market swings and then planning to buy somewhere below this line and to sell somewhere above it. Perhaps such a system would be as practical as any, but the analyst is likely to insist on a more scientific approach. One possible refinement would operate as follows. 1. Select a diversified list of leading industrial common stocks. 2. Determine a base or normal value for the group by capitalizing their average earnings at some suitable figure related to the going long-term interest rate. 3. Determine a buying point at some percentage below this normal value and a selling point above it. Or buying and selling may be done on a scale down and on a scale up. A method of this kind has plausible logic to recommend it, and it is favored also by an age-old tradition that success in the stock market is gained by buying at depressed levels and selling out when the public is optimistic. But the reader will suspect at once that there is a catch to it somewhere. What are its drawbacks? As we see it, the difficulties attending this idea are threefold. First, although the general pattern of the market's behavior may be properly anticipated, the specific buying and selling points may turn out to have been badly chosen, and the operator may miss his opportunity at one extreme or the other. Second, there is always a chance that the character of the market's behavior may change significantly, so that a scheme of operation that would have worked well in the past will cease to be practicable. Third, the method itself requires a considerable amount of human fortitude. It generally involves buying and selling when the prevalent psychology favors the opposite course, watching one's shares go lower after purchase and higher after sale, and often staying out of the market for long periods. For example, 1927 to 1930, when most people are actively interested in stocks. But despite these disadvantages, which we do not minimize, it is our view that this method has a good deal to commend it to those temperamentally qualified to follow it. The undervalued individual issue approach. The other application of the principle of investing in undervalued common stocks is directed at individual issues, which upon analysis appear to be worth substantially more than they are selling for. It is rare that a common stock will appear satisfactory from every qualitative angle, and at the same time will be found to be selling at a low price by such quantitative standards as earnings, dividends, and assets. Issues of this type would undoubtedly be eligible for a group purchase that would fulfill our supplementary criterion of investment given in Chapter 4. An investment operation is one that can be justified on both qualitative and quantitative grounds. Of more practical importance is the question whether or not investment can be successfully carried out in common stocks that appear cheap from the quantitative angle and that, upon study, seem to have average prospects for the future. Securities of this type can be found in reasonable abundance as a result of the stock market's obsession with companies considered to have unusually good prospects of growth. Because of this emphasis on the growth factor, quite a number of enterprises that are long established, well-financed, important in their industries, and presumably destined to stay in business and make profits indefinitely in the future, but that have no speculative or growth appeal, tend to be discriminated against by the stock market, especially in years of subnormal profits, and to sell for considerably less than the business would be worth to a private owner. We incline strongly to the belief that this last criterion, a price far less than value to a private owner, will constitute a sound touchstone for the discovery of true investment opportunities in common stocks. This view runs counter to the convictions and practice of most people seeking to invest in equities, including practically all the investment trusts. Their emphasis is mainly on long-term growth, prospects for the next year, or the indicated trend of the stock market itself. Undoubtedly, any of these three viewpoints may be followed successfully by those especially well equipped by experience and native ability to exploit them. But we are not so sure that any of these approaches can be developed into a system or technique that can be confidently followed by everyone of sound intelligence who has studied it with care. Hence, we must raise our solitary voice against the use of the term investment to characterize these methods of operating in common stocks, however profitable they may be to the truly skillful. Trading in the market, forecasting next year's results for various businesses, selecting the best media for long-term expansion, all these have a useful place in Wall Street. But we think that the interests of investors and of Wall Street as an institution would be better served if operations based primarily on these factors were called by some other name than investment. Whether or not our own concept of common stock investment is a valid one may be more intelligently considered after we have given extended treatment to the chief factors that enter into a statistical analysis of a stock issue. The need for such analysis is quite independent of our investment philosophy. After all, common stocks exist and are actively dealt in by the public. Those who buy and sell will properly seek to arm themselves with an adequate knowledge of financial practice and with the tools and technique necessary for an intelligent analysis of corporate statements. Such information and equipment for the common stock investor form the subject matter of the following chapters. Chapter 29. The Dividend Factor in Common Stock Analysis. A natural classification of the elements entering into the valuation of a common stock would be under the three headings: 1. The dividend rate and record; 2. Income account factors, earning power; 3. Balance sheet factors, asset value. The dividend rate is a simple fact and requires no analysis, but its exact significance is exceedingly difficult to appraise. From one point of view, the dividend rate is all important, but from another and equally valid standpoint, it must be considered an accidental and minor factor. A basic confusion has grown up in the minds of managements and stockholders alike as to what constitutes a proper dividend policy. The result has been to create a definite conflict between two aspects of common stock ownership, one being the possession of a marketable security, and the other being the assumption of a partnership interest in a business. Let us consider the matter in detail from this twofold approach. Dividend return as a factor in common stock investment. Until recent years, the dividend return was the overshadowing factor in common stock investment. This point of view was based on simple logic. The prime purpose of a business corporation is to pay dividends to its owners. A successful company is one that can pay dividends regularly and presumably increase the rate as time goes on. Since the idea of investment is closely bound up with that of dependable income, it follows that investment in common stocks would ordinarily be confined to those with a well-established dividend. It would follow also that the price paid for an investment common stock would be determined chiefly by the amount of the dividend. We have seen that the traditional common stock investor sought to place himself as nearly as possible in the position of an investor in a bond or preferred stock. He aimed primarily at a steady income return, which in general would be both somewhat larger and somewhat less certain than that provided by good senior securities. Excellent illustrations of the effect of this attitude upon the price of common stocks are afforded by the records of the earnings, dividends, and annual price variations of American Sugar Refining between 1907 and 1913, and of Atchison, Topeka, and Santa Fe Railway between 1916 and 1925, presented herewith in the following charts, which may be found in the accompanying PDF. The market range of both issues is surprisingly narrow, considering the continuous gyrations of the stock market generally during those periods. The most striking feature of the exhibit is the slight influence exercised both by the irregular earnings of American Sugar and by the exceptionally well-maintained and increasing earning power on the part of Atchison. It is clear that the price of American Sugar was dominated throughout by its $7 rate and that of Atchison by its $6 rate, even though the earnings records would apparently have justified an entirely different range of relative market values. Established principle of withholding dividends. We have, therefore, on the one hand, an ingrained and powerfully motivated tradition which centers investment interest upon the present and past dividend rate. But on the other hand, we have an equally authoritative and well-established principle of corporate management which subordinates the current dividend to the future welfare of the company and its shareholders. It is considered proper managerial policy to withhold current earnings from stockholders for the sake of any of the following advantages. 1. To strengthen the financial, working capital position. 2. To increase productive capacity. 3. To eliminate an original overcapitalization. When a management withholds and reinvests profits, thus building up an accumulated surplus, it claims confidently to be acting for the best interests of the shareholders. For by this policy, the continuance of the established dividend rate is undoubtedly better assured, and furthermore, a gradual but continuous increase in the regular payment is thereby made possible. The rank and file of stockholders will give such policies their support, either because they are individually convinced that this procedure redounds to their advantage, or because they accept uncritically the authority of the managements and bankers who recommend it. But this approval by stockholders of what is called a conservative dividend policy has about it a peculiar element of the perfunctory and even the reluctant. The typical investor would most certainly prefer to have his dividend today and let tomorrow take care of itself. No instances are on record in which the withholding of dividends for the sake of future profits has been hailed with such enthusiasm as to advance the price of the stock. The direct opposite has invariably been true. Given two companies in the same general position and with the same earning power, the one paying the larger dividend will always sell at the higher price. Policy of withholding dividends questionable. This is an arresting fact, and it should serve to call into question the traditional theory of corporate finance that the smaller the percentage of earnings paid out in dividends, the better for the company and its stockholders. Although investors have been taught to pay lip service to this theory, their instincts and perhaps their better judgment are in revolt against it. If we try to bring a fresh and critical viewpoint to bear upon this subject, we shall find that weighty objections may be leveled against the accepted dividend policy of American corporations. Examining this policy more closely, we see that it rests upon two quite distinct assumptions. The first is that it is advantageous to the stockholders to leave a substantial part of the annual earnings in the business. The second is that it is desirable to maintain a steady dividend rate in the face of fluctuations in profits. As to the second point, there would be no question at all, provided the dividend stability is achieved without too great sacrifice in the amount of the dividend. Assume that the earnings vary between $5 and $15 annually over a period of years, averaging $10. No doubt the stockholders' advantage would be best served by maintaining a stable dividend rate of $8, sometimes drawing upon the surplus to maintain it, but on the average increasing the surplus at the rate of $2 per share annually. This would be an ideal arrangement, but in practice it is rarely followed. We find that stability of dividends is usually accomplished by the simple expedient of paying out a small part of the average earnings. By a reductio ad absurdum, it is clear that any company that earned $10 per share on the average could readily stabilize its dividend at $1. The question arises very properly if the shareholders might not prefer a much larger aggregate dividend, even with some irregularity. This point is well illustrated in the case of Atchison. The case of Atchison. Atchison maintained its dividend at the annual rate of $6 for the 15 years between 1910 and 1924. During this time, the average earnings were in excess of $12 per share, so that the stability was attained by withholding over half the earnings from the stockholders. Eventually, this policy bore fruit in an advance of the dividend to $10, which rate was paid between 1927 and 1931, and was accompanied by a rise in the market price to nearly $300 per share in 1929. Within 6 months after the last payment at the $10 rate, in December 1931, the dividend was omitted entirely. Viewed critically, the stability of the Atchison dividend between 1910 and 1924 must be considered as of dubious benefit to the stockholders. During its continuance, they received an unduly small return in relation to the earnings. When the rate was finally advanced, the importance attached to such a move promoted excessive speculation in the shares. Finally, the reinvestment of the enormous sums out of earnings failed to protect the shareholders from a complete loss of income in 1932. Allowance must be made, of course, for the unprecedented character of the Depression in 1932. But the fact remains that the actual operating losses in dollars per share up to the passing of the dividend were entirely insignificant in comparison with the surplus accumulated out of the profits of previous years. United States Steel, another example. The Atchison case illustrates the two major objections to what is characterized and generally approved of as a conservative dividend policy. The first objection is that stockholders receive both currently and ultimately too low a return in relation to the earnings of their property. The second is that the saving up of profits for a rainy day often fails to safeguard even the moderate dividend rate when the rainy day actually arrives. A similarly striking example of the ineffectiveness of a large accumulated surplus is shown by that leading industrial enterprise, United States Steel. The following figures tell a remarkable story. Profits available for the common stock, 1901 to 1930, $2,344 million. Dividends paid, cash, $891 million. Stock, $203 million. Undistributed earnings, $1,250 million. Loss after preferred dividends, January 1, 1931 to June 30, 1932, $59 million. Common dividend passed June 30, 1932. A year and a half of declining business was sufficient to outweigh the beneficial influence of 30 years of practically continuous reinvestment of profits. The merits of plowing back earnings. These examples serve to direct our critical attention to the other assumption on which American dividend policies are based, viz., that it is advantageous to the stockholders if a large portion of the annual earnings are retained in the business. This may well be true, but in determining its truth, a number of factors must be considered that are usually left out of account. The customary reasoning on this point may be stated in the form of a syllogism as follows. Major premise: whatever benefits the company benefits the stockholders. Minor premise: a company is benefited if its earnings are retained rather than paid out in dividends. Conclusion: stockholders are benefited by the withholding of corporate earnings. The weakness of the foregoing reasoning rests, of course, in the major premise. Whatever benefits a business benefits its owners, provided the benefit is not conferred upon the corporation at the expense of the stockholders. Taking money away from the stockholders and presenting it to the company will undoubtedly strengthen the enterprise, but whether or not it is to the owner's advantage is an entirely different question. It is customary to commend managements for plowing earnings back into the property, but in measuring the benefits from such a policy, the time element is usually left out of account. It stands to reason that, if a business paid out only a small part of its earnings in dividends, the value of the stock should increase over a period of years. But it is by no means so certain that this increase will compensate the stockholders for the dividends withheld from them, particularly if interest on these amounts is compounded. An inductive study would undoubtedly show that the earning power of corporations does not in general expand proportionately with increases in accumulated surplus. Assuming that the reported earnings were actually available for distribution, then stockholders in general would certainly fare better in dollars and cents if they drew out practically all of these earnings in dividends. An unconscious realization of this fact has much to do with the tendency of common stocks paying liberal dividends to sell higher than others with the same earning power, but paying out only a small part thereof. Dividend policies arbitrary and sometimes selfishly determined. One of the obstacles in the way of an intelligent understanding by stockholders of the dividend question is the accepted notion that the determination of dividend policies is entirely a managerial function, in the same way as the general running of the business. This is legally true, and the courts will not interfere with the dividend action or inaction except upon an exceedingly convincing showing of unfairness. But if stockholders' opinions were properly informed, it would insist upon curtailing the despotic powers given the directorate over the dividend policy. Experience shows that these unrestricted powers are likely to be abused for various reasons. Boards of directors usually consist largely of executive officers and their friends. The officers are naturally desirous of retaining as much cash as possible in the treasury in order to simplify their financial problems. They are also inclined to expand the business persistently for the sake of personal aggrandizement and to secure higher salaries. This is a leading cause in the unwise increase of manufacturing facilities, which has proved recurrently one of the chief unsettling factors in our economic situation. The discretionary power over the dividend policy may also be abused in more sinister fashion, sometimes to permit the acquisition of shares at an unduly low price, at other times to facilitate unloading at a high quotation. The heavy surtaxes imposed upon large incomes frequently make it undesirable from the standpoint of the large stockholders that earnings be paid out in dividends. Hence, dividend policies may be determined at times from the standpoint of the taxable status of the large stockholders who control the directorate. This is particularly true in cases where these dominant stockholders receive substantial salaries as executives. In such cases, they are perfectly willing to leave their share of the earnings in the corporate treasury, since the latter is under their control, and since by so doing they retain control over the earnings accruing to the other stockholders as well. Arbitrary control of dividend policy complicates analysis of common stocks. Viewing American corporate dividend policies as a whole, it cannot be said that the virtually unlimited power given the management on this score has redounded to the benefit of the stockholders. In entirely too many cases, the right to pay out or withhold earnings at will is exercised in an unintelligent or inequitable manner. Dividend policies are often so arbitrarily managed as to introduce an additional uncertainty in the analysis of a common stock. Besides the difficulty of judging the earning power, there is the second difficulty of predicting what part of the earnings the directors will see fit to disperse in dividends. It is important to note that this feature is peculiar to American corporate finance and has no close counterpart in the other important countries. The typical English, French, or German company pays out practically all the earnings of each year except those carried to reserves. Hence, they do not build up large profit and loss surpluses such as are common in the United States. Capital for expansion purposes is provided abroad not out of undistributed earnings, but through the sale of additional stock. To some extent, perhaps, the reserve accounts shown in foreign balance sheets will serve the same purpose as an American surplus account, but these reserve accounts rarely attain a comparable magnitude. Plowing back due to watered stock. The American theory of plowing back earnings appears to have grown out of the stock watering practices of pre-war days. Many of our large industrial companies made their initial appearance with no tangible assets behind their common shares and with inadequate protection for their preferred issues. Hence, it was natural that the management should seek to make good these deficiencies out of subsequent earnings. This was particularly true because additional stock could not be sold at its par value, and it was difficult, therefore, to obtain new capital for expansion except through undistributed profits. Examples. Concrete examples of the relation between overcapitalization and dividend policies are afforded by the outstanding cases of Woolworth and United States Steel Corporation. In the original sale of F.W. Woolworth Company shares to the public made in 1911, the company issued preferred stock to represent all the tangible assets and common stock to represent the goodwill. The balance sheet accordingly carried a goodwill item of $50 million among the assets, offsetting a corresponding liability for 500,000 shares of common, par $100. As Woolworth prospered, a large surplus was built up out of earnings, and amounts were charged against this surplus to reduce the goodwill account until finally it was written down to $1. In the case of United States Steel Corporation, the original capitalization exceeded tangible assets by no less than $768 million, representing all the common and more than half the preferred stock. This water in the balance sheet was not shown as a goodwill item, as in the case of Woolworth, but was concealed by an overvaluation of the fixed assets, that is, of the property investment accounts. Through various accounting methods, however, the management applied earnings from operations to the writing off of these intangible or fictitious assets. By the end of 1929, a total of $508 million, equal to the entire original common stock issue, had been taken from earnings or surplus and deducted from the property account. The balance of $260 million was set up separately as an intangible asset in the 1937 report and then written off entirely in 1938 by means of a reduction in the stated value of the common stock. Some of the accounting policies above referred to will be discussed again with respect to their influence on investment values in our chapters on analysis of the income account and balance sheet analysis. From the dividend standpoint, it is clear that in both of these examples, the decision to retain large amounts of earnings instead of paying them out to the stockholders was due in part to the desire to eliminate intangible items from the asset accounts. Conclusions from the foregoing. From the foregoing discussion, certain conclusions may be drawn. These bear, first, on the very practical question of what significance should be accorded the dividend rate as compared with the reported earnings, and, secondly, upon the more theoretical but exceedingly important question of what dividend policy should be considered as most desirable from the standpoint of the stockholder's interest. Experience would confirm the established verdict of the stock market that $1 of earnings is worth more to the stockholder if paid him in dividends than when carried to surplus. The common stock investor should ordinarily require both an adequate earning power and an adequate dividend. If the dividend is disproportionately small, an investment purchase will be justified only on an exceptionally impressive showing of earnings, or by a very special situation with respect to liquid assets. On the other hand, of course, an extra-liberal dividend policy cannot compensate for inadequate earnings, since with such a showing the dividend rate must necessarily be undependable. To aid in developing these ideas quantitatively, we submit the following definitions. The dividend rate is the amount of annual dividends paid per share expressed either in dollars or as a percentage of a $100 par value. If the par value is less than $100, it is inadvisable to refer to the dividend rate as a percentage figure, since this may lead to confusion. The earnings rate is the amount of annual earnings per share expressed either in dollars or as a percentage of a $100 par value. The dividend ratio, dividend return, or dividend yield is the ratio of the dividend paid to the market price. For example, a stock paying $6 annually and selling at $1.20 has a dividend ratio of 5%. The earnings ratio, earnings return, or earnings yield is the ratio of the annual earnings to the market price. For example, a stock earning $6 and selling at $50 shows an earnings yield of 12%. Let us assume that a common stock, A, with average prospects, earning $7 and paying $5, should sell at $100. This is a 7% earnings ratio and 5% dividend return. Then, a similar common stock, B, earning $7 but paying only $4, should sell lower than $100. Its price evidently should be somewhere between $80, representing a 5% dividend yield, and $100, representing a 7% earnings yield. In general, the price should tend to be established nearer to the lower limit than to the upper limit. A fair approximation of the proper relative price would be about 90 at which level the dividend yield is 4.44% and the earnings ratio is 7.78%. If the investor makes a small concession in dividend yield below the standard, he is entitled to demand a more than corresponding increase in the earning power above standard. In the opposite case, a similar stock, C, may earn $7 but pay $6. Here, the investor is justified in paying some premium above 100 because of the larger dividend. The upper limit, of course, would be 120, at which price the dividend ratio would be the standard 5%, but the earnings ratio would be only 5.83%. Here again, the proper price should be closer to the lower than to the upper limit, say 108, at which figure the dividend yield would be 5.56%, and the earnings ratio 6.48%. Suggested principle for dividend payments. Although these figures are arbitrarily taken, they correspond fairly well with the actualities of investment values under what seem now to be reasonably normal conditions in the stock market. The dividend rate is seen to be important, apart from the earnings, not only because the investor naturally wants cash income from his capital, but also because the earnings that are not paid out in dividends have a tendency to lose part of their effective value for the stockholder. Because of this fact, American shareholders would do well to adopt a different attitude than hitherto with respect to corporate dividend policies. We should suggest the following principle as a desirable modification of the traditional viewpoint. Principle: stockholders are entitled to receive the earnings on their capital except to the extent they decide to reinvest them in the business. The management should retain or reinvest earnings only with the specific approval of the stockholders. Such earnings as must be retained to protect the company's position are not true earnings at all. They should not be reported as profits, but should be deducted in the income statement as necessary reserves with an adequate explanation thereof. A compulsory surplus is an imaginary surplus. Were this principle to be generally accepted, the withholding of earnings would not be taken as a matter of course and of arbitrary determination by the management, but it would require justification corresponding to that now expected in the case of changes in capitalization and of the sale of additional stock. The result would be to subject dividend policies to greater scrutiny and more intelligent criticism than they now receive, thus imposing a salutary check upon the tendency of managements to expand unwisely and to accumulate excessive working capital. If it should become the standard policy to disperse the major portion of each year's earnings, as is done abroad, then the rate of dividend will vary with business conditions. This would apparently introduce an added factor of instability into stock values. But the objection to the present practice is that it fails to produce the stable dividend rate, which is its avowed purpose and the justification for the sacrifice it imposes. Hence, instead of a dependable dividend that mitigates the uncertainty of earnings, we have a frequently arbitrary and unaccountable dividend policy that aggravates the earnings hazard. The sensible remedy would be to transfer to the stockholder the task of averaging out his own annual income return. Since the common stock investor must form some fairly satisfactory opinion of average earning power, which transcends the annual fluctuations, he may as readily accustom himself to forming a similar idea of average income. As in fact the two ideas are substantially identical, dividend fluctuations of this kind would not make matters more difficult for the common stock investor. In the end, such fluctuations will work out more to his advantage than the present method of attempting, usually unsuccessfully, to stabilize the dividend by large additions to the surplus account. On the former basis, the stockholder's average income would probably be considerably larger. A paradox. Although we have concluded that the payment of a liberal portion of the earnings in dividends adds definitely to the attractiveness of a common stock, it must be recognized that this conclusion involves a curious paradox. Value is increased by taking away value. The more the stockholder subtracts in dividends from the capital and surplus fund, the larger value he places upon what is left. It is like the famous legend of the Sibylline books, except that here the price of the remainder is increased because part has been taken away. This point is well illustrated by a comparison of Atchison and Union Pacific, two railroads of similar standing, over the 10-year period between January 1, 1915 and December 31, 1924. This comparison may be found in the accompanying PDF. It is to be noted that because Atchison failed to increase its dividend, the market price of the shares failed to reflect adequately the large increase both in earning power and in book value. The more liberal dividend policy of Union Pacific produced the opposite result. This anomaly of the stock market is explained in good part by the underlying conflict of the two prevailing ideas regarding dividends, which we have discussed in this chapter. In the following brief summary of the situation, we endeavor to indicate the relation between the theoretical and the practical aspects of the dividend question. Summary. 1. In some cases, the stockholders derive positive benefits from an ultra-conservative dividend policy, that is, through much larger eventual earnings and dividends. In such instances, the market's judgment proves to be wrong in penalizing the shares because of their small dividend. The price of these shares should be higher rather than lower on account of the fact that profits have been added to surplus instead of having been paid out in dividends. 2. Far more frequently, however, the stockholders derive much greater benefits from dividend payments than from additions to surplus. This happens because either A, the reinvested profits fail to add proportionately to the earning power, or B, they are not true profits at all, but reserves that had to be retained merely to protect the business. In this majority of cases, the market's disposition to emphasize the dividend and to ignore the additions to surplus turns out to be sound. 3. The confusion of thought arises from the fact that the stockholder votes in accordance with the first premise and invests on the basis of the second. If the stockholders asserted themselves intelligently, this paradox would tend to disappear. For in that case, the withholding of a large percentage of the earnings would become an exceptional practice, subject to close scrutiny by the stockholders and presumably approved by them from a considered conviction that such retention would be beneficial to the owners of the shares. Such a ceremonious endorsement of a low dividend rate would probably and properly dispel the stock market's skepticism on this point and permit the price to reflect the earnings that are accumulating as well as those which were paid out. The foregoing discussion may appear to conflict with the suggestion advanced in the previous chapter that long-term increases in common stock values are often due to the reinvestment of undistributed profits. We must distinguish here between the two lines of argument. Taking our standard case of a company earning $10 per share and paying dividends of $7, we have pointed out that the repeated annual additions of $3 per share to surplus should serve to increase the value of the stock over a period of years. This may very well be true, and at the same time the rate of increase in value may be substantially less than $3 per annum compounded. If we take the reverse case, viz. $3 paid in dividends and $7 added to surplus, the distinction is clearer. Undoubtedly, the large addition to surplus will expand the value of the stock, but quite probably also this value will fail to increase at the annual rate of $7 compounded. Hence, the argument against reinvesting large proportions of the yearly earnings would remain perfectly valid. Our criticism is advanced against the latter type of policy, for example, the retention of 70% of the earnings, and not against the normal reinvestment of some 30% of the profits. Dividend policy since 1934. If the dividend practice of American corporations were to be judged solely by the record during 1934 to 1939, the criticism expressed in this chapter would have to be softened considerably. In these recent years, there has been a definite tendency towards greater liberality in dividend payments, particularly by companies that do not have clearly defined opportunities for profitable expansion. Retention of earnings by rapidly growing enterprises, for example airplane manufacturers, is hardly open to objection. Since the end of 1932, on the other hand, General Motors Corporation has dispersed about 80% of earnings to common stockholders with no wide deviation in any year through 1939. In 1939, the Treasury Department announced that it would use 70% as a rough or preliminary test to decide whether or not a company is subject to the penalty taxes for improper accumulation of surplus. As far as stock prices are concerned, it can hardly be said that they have been unduly influenced by arbitrary dividend policies in these recent years. For not only have the policies themselves been far less arbitrary than in former times, but there has been a definite tendency in the stock market to subordinate the dividend factor to the reported and prospective earnings. The undistributed profits tax. The more liberal dividends of recent years have been due in part to the highly controversial tax on undistributed profits. This was imposed by Congress in 1936 on a graduated scale running from 7 to 27%. Following violent criticism, the tax was reduced to a vestigial 2.5% in 1938 and repealed entirely the following year. Its main object was to compel companies to distribute their earnings so that they might be subject to personal income taxes levied against the stockholders. A secondary objective appears to have been to restrict the accumulation of corporate surpluses, which were thought by some to be injurious, either because they withheld purchasing power from individuals or because they were conducive to unwise expansion. But the tax was widely and violently condemned, chiefly on the ground that it prevented the creation of surplus or reserve funds essential to meet future losses or emergencies or expansion needs. It was said to lay a heavy penalty on corporate thrift and prudence, and to bear with particular severity on small or new corporations which must rely largely on retained profits for their growth. Law objectionable but criticized on wrong grounds. In our own opinion, the law was a very bad one, but it has been criticized largely on the wrong grounds. Its objective, as first announced, was to tax corporations exactly as if they were partnerships, and hence to equalize the taxation basis of corporate and unincorporated businesses. Much could be said in favor of this aim. But as the bill was finally passed, it effectively superposed partnership taxation on top of corporate taxation, thus heavily discriminating against the corporate form and especially against small stockholders. Nor was it a practicable tax as far as wealthy holders were concerned, because the extremely high personal tax rates, combined with the corporation taxes, state and federal, created an overall burden undoubtedly hostile to individual initiative. Fully as bad were the technical details of the tax law, which compelled distributions in excess of actual accounting profits, disregarded very real capital losses, and allowed no flexibility in the treatment of inventory values. Despite the almost universal opinion to the contrary, we do not believe that the undistributed profits tax really prevented the reinvestment of earnings, except to the extent that these were diminished by personal income taxes, as they would be in an unincorporated business. Corporations had available a number of methods for retaining or recovering these earnings without subjecting them to the penalty tax. These devices included 1. Declaration of taxable stock dividends, for example in preferred stock. 2. Payment of optional dividends, so contrived as to impel the stockholders to take stock rather than cash. 3. Offering of additional stock on attractive terms at the time of payment of cash dividends. Critics of the tax have asserted that these methods are inconvenient or impracticable. Our own observation is that they were quite practicable and were resorted to by a fair number of corporations in 1936 and 1937, but that they were avoided by the majority either from unfamiliarity or from a desire to throw as harsh a light as possible upon the law. Proper dividend policy. In view of the skepticism that we have expressed as to whether or not stockholders are really benefited by dividend withholding policies, we may be thought sympathetic to the idea of preventing reinvestment of profits by imposing penalty taxes thereon. This is far from true. Dividend and reinvestment policy should be controlled not by law, but by the intelligent decision of stockholders. Individual cases may well justify retention of earnings to an extent far greater than is ordinarily desirable. The practice should vary with the circumstances. The policy should be determined and proposed in the first instance by the management, but it should be subject to independent consideration and appraisal by stockholders in their own interest, as distinguished from that of the corporation as a separate entity or the management as a special group. Chapter 30. Stock Dividends. Distributions made in the form of stock instead of cash are of two kinds, which may be called extraordinary and periodic. An extraordinary stock dividend may be deemed as one that capitalizes part of the accumulated surplus of past years. That is, it transfers a substantial amount from the accumulated surplus to stated capital and gives the stockholders additional shares to represent the funds thus transferred. A periodic stock dividend may be defined as one that capitalizes part of only the current year's earnings. Hence, it is almost always of relatively small size. It is called periodic because such dividends are usually repeated over a number of years in accordance with an established policy. Extraordinary stock dividends. Extraordinary stock dividends are legal and legitimate, but by and large they produce unfortunate effects. The only reason for such a dividend that is at once sound and practical is that it will adjust the market price of the shares to a more convenient level. Widespread public interest and an active market are desirable attributes of a common stock, and these are diminished when the normal price range has advanced to such a high figure as, say, $300 or $400 per share. Hence, an increase in the number of shares and the reduction in value of each share by means of a large stock dividend would be a logical step to take. Example: in 1917, Bethlehem Steel stock was selling above $500 per share. A stock dividend of 200% was paid, and additional shares were sold at par, bringing the market price down to about $150. Split-ups. Exactly the same result may be obtained by reducing the par value of the shares, such a move being referred to familiarly as a split-up. During the bull market of the 1920s, reductions in par value were much more frequent than large stock dividends on stocks with par value because the rise in market price had so far outstripped the accumulated surplus that a distribution of the latter would have been insufficient for the purpose. Example: in 1926, General Electric stock was selling at $360. 4 new shares of no par value were given for each old share of $100 par value, thus reducing the market price to about $90. To have effected the same result by a 300% stock dividend would have required the transfer of $540 million from surplus to capital, but the surplus was then only $100 million. A similar situation existed in 1930 when General Electric shares were again split 4-for-1. In the case of Woolworth, the original common issue of 500,000 shares was increased to 9,750,000 shares by the following steps, involving both stock dividends and split-ups. 1920, stock dividend of 30%, reducing the price from about $140 to about $110. 650,000 total shares outstanding. 1924, par value cut from $100 to $25, reducing the price from about $320 to about $80. Total shares outstanding, 2,600,000. 1927, stock dividend of 50%, reducing the price from about $180 to about $120. Total shares outstanding, 3,900,000. 1929, par value cut from $25 to $10, reducing the price from about $225 to about $90. Total shares outstanding, 9,750,000. American Can combined both devices at one time in 1926. It reduced the par value from $100 to $25 and also paid a stock dividend of 50%. Hence, 6 shares were issued for 1, and the price was reduced from about $300 to about $50. Stock splits and stock dividends in no par stock. In the case of common stocks of no par value, a split-up or stock dividend leads to exactly the same results, and to all practical purposes they are indistinguishable. Although a stock dividend requires the transfer of a certain sum on the books from surplus to capital, the infinite latitude in accounting permitted by no par stock may make this transfer a purely nominal affair. Examples. Central States Electric Corporation paid a 900% stock dividend in 1926, increasing the number of shares, no par, from 109,000 to 1,090,000. The old stock had a book value of about $44 per share at the end of 1925, but the new stock was charged against surplus at the rate of only $1 per share. Similarly, in 1929, the Coca-Cola Company paid a 100% stock dividend in Class A stock without par value. This stock was booked at $5 per share, lower than the stated value of the common, despite the fact that the Class A stock has all of the characteristics of a $50 par, 6% preferred issue, except formal designation of such a par figure. See also the accounting by this company of its 100% dividend payable in common stock in 1927, and also our discussion of its treatment of repurchases of Class A shares in Chapter 42. Objections to extraordinary stock dividends and split-ups. Extraordinary stock dividends and stock split-ups are both open to the serious objection that their declaration exercises an undue influence upon market prices, and hence that they afford an avenue for manipulation and for unfair profits by insiders. It is obvious that in theory a large stock dividend gives the stockholder nothing that he did not own before. His two pieces of paper now represent the same ownership formerly expressed by one piece of paper. This reasoning led the United States Supreme Court to decide that stock dividends are not income and consequently not subject to income tax. In practice, however, a stock dividend may readily be given exceptional speculative importance, for stock speculation is largely a matter of A trying to decide what B, C, and D are likely to think, with B, C, and D trying to do the same. Hence, a stock dividend, even if it has no real significance of any kind, can and does serve as a stimulus to that mutual attempt at taking advantage of each other, which often lies at the bottom of speculators' activities. Effects on the cash dividend rate. The essentially elusive character of large stock dividends would be more evident were it not for the fact that an investment element of real importance may also enter into the picture. The payment of an extraordinary stock dividend is usually the forerunner of an increase in the regular cash dividend rate. Since investors are legitimately interested in the cash dividend, they must necessarily be interested also in any stock dividend, for this may have a bearing upon the probable cash dividend. This serves to confuse the issue and to make less obtrusive the purely manipulative aspects of stock dividend declarations. The dividend history of a successful industrial corporation frequently discloses the following sequence. 1. A protracted period of small dividends in relation to earnings with the upbuilding of a huge surplus. 2. The sudden payment of a large stock dividend. 3. An immediate increase in the regular cash dividend payments. No policy could be more conducive to the confusion of investment and speculative attitudes or lend itself more easily to the taking of unfair advantage by those in control. Periodic stock dividends. This policy represents a great advance in basic soundness over the haphazard and often inequitable practices that we have been discussing. Such practices involve first, the large accumulation of undistributed earnings in the surplus account, and second, the ultimate capitalization thereof through stock dividends at arbitrary times and in arbitrary amounts. Assuming that in many cases it may be desirable to retain a good part of each year's earnings in the business, then the interests of the stockholders would be best served by giving them currently a tangible evidence of their ownership of these reinvested profits. If an enterprise regularly earns $12 per share and pays out only $5 in cash, the stockholders would benefit greatly by receiving each year a stock dividend representing a good part of the $7 added to their company's resources. In theory, of course, the additional stock certificate gives him nothing that he would not own without it. In other words, without a stock dividend, his old certificate would still fully represent the ownership of the added $7 per share. But in actuality, the payment of periodic stock dividends produces important advantages. Among them are the following. 1. The stockholder can sell the stock dividend certificate so that at his option he can have either cash or more stock to represent the reinvested earnings. Without a stock dividend, he might in theory accomplish the same end by selling a small part of the shares represented by his old certificate, but in practice this is difficult to calculate and inconvenient in execution. 2. He is likely to receive larger cash dividends as a result of such a policy because the established cash rate will usually be continued on the increased number of shares. For example, if a company earning $12 pays out $6 in cash and 5% in stock, in the next year it will most probably pay $6 in cash on the new capitalization, equivalent to $5.25 on the previous holdings. Without the stock dividend, it would probably continue the $5 rate unchanged. 3. By adding the reinvested profits to the stated capital instead of to surplus, the management is placed under a direct obligation to earn money and pay dividends on these added resources. No such accountability exists with respect to the profit and loss surplus. The stock dividend procedure will serve not only as a challenge to the efficiency of the management, but also as a proper test of the wisdom of reinvesting the sums involved. 4. Issues paying periodic stock dividends enjoy a higher market value than similar common stocks not paying such dividends. Variations in the practice of periodic stock dividend payment. The practice of dispersing periodic stock dividends developed fairly rapidly from about 1923 until the subsequent Depression. 3 variations of the idea were resorted to. 1. The standard method was to pay a stock dividend in addition to the regular cash dividend. These stock dividends were paid either monthly, quarterly, semi-annually, or annually. 2. Sometimes a periodic stock dividend was offered in lieu of the regular cash dividend. This took the form of an option to the stockholder to take a certain amount of either cash or stock. Example: the Seagrave Corporation paid a dividend quarterly at the annual rate of either $1.20 in cash or 10% in stock between 1925 and 1929 inclusive. 3. In a few cases, stock dividends only were paid with no cash disbursement or option. The most prominent exponent of periodic stock dividends, the North American Company, followed this procedure by paying dividends of 2.5% in stock quarterly between 1923 and 1933, in which latter year the payment was reduced to 2% quarterly. In 1935, the company gave up the stock dividend policy and returned to a cash dividend basis. Objectionable feature of periodic stock dividends. Nearly every financial practice is open to abuse, and periodic stock dividends have proved no exception. The objectionable feature in this case has been to establish a regular stock dividend rate exceeding in market value the amount of the earnings carried to surplus. This practice makes the issue appear unduly attractive to the unintelligent buyer who is deceived by the high cash value of the current payments in stock. It requires some insight into corporate accounting methods to realize the true significance of such stock dividend payments. Let us use the outstanding North American Company case as an illustration. As we have stated, this company paid continuous stock dividends on the common shares at the rate of 10% annually for 10 years. During most of this period, the 10% stock dividend represented a payment of only $1 per share as far as its books were concerned. This followed from the fact that prior to 1927 the par value of the stock was $10, and that after the shares were made no par, they were still given a stated value on the books at $10 per share. Hence, 10% of either the par or the stated value amounted to only $1 per share. But from the investor's viewpoint, he was receiving dividends worth much more than $1 per share, because the market price of North American common far exceeded its par or stated value. It will be noted that beginning with the third quarterly payment in 1931, the amount charged against earnings for the stock dividend was advanced from $1 to $1,468 per share annually. This followed a request from the New York Stock Exchange that the charge against earnings or earned surplus covering the stock dividends reflect the interest of the new shares in the capital surplus as well as in the stated capital. Even after this change was made, however, there remained a wide discrepancy between the amount at which the dividends were valued on the books and the value given these dividends by the stock market and presumably by the stockholders, until the quotation suffered a further severe decline. Danger of vicious circle developing. An arrangement of this kind is likely to develop into a vicious circle. The higher the market price, the greater the apparent value of the stock dividends, which in turn will seem to justify a still higher market price. With a 10% stock dividend, the dividend return obviously remains at 10% regardless of how high the market price may climb. Such a result is deceptive and supplies an unwholesome impetus to riotous speculation as well as to thoughtless investment. In effect, it is the opposite of the practice followed many years ago by such companies as American Can and National Biscuit, when the market price was kept far below the true value of the shares by an unduly conservative dividend policy. It is fully as objectionable, of course, to pursue a policy calculated to create a market price higher than that warranted by the earnings and other value factors. Such an unjustified price must necessarily be of temporary duration and is likely to result, as does all improper accounting, in giving the initiated an unfair advantage over the investing public. Historical development. From the historical standpoint, it is interesting to note that the North American company began its stock dividend policy at about the same time that the first protagonist of the idea had decided to abandon it. This was the American Light and Traction Company, which during 1910 to 1919 had paid dividends at the annual rate of both $10 in cash and 10% in stock. During 1916, when the stock sold at about $400, the stockholders were receiving dividends with a realizable value of some $50 annually, although the earnings were only about $25 per share. Such a dividend policy could be permanently successful only if the company could continuously reinvest in its business ever-increasing amounts of profits, upon which in turn it could realize 20% annually. The law of diminishing returns and the voracious growth of compound interest would clearly outlaw such a possibility. In the Depression of 1920 to 1921, American Light and Traction found it necessary to reduce its dividend rate sharply. The market quotation fell below 80, an astounding decline for an investment stock during that period. The price of Atchison during the years 1916 to 1921 was between 109 and 76. This experience led the directors to give up the periodic stock dividend idea in 1925, at the very time when it was coming into general favor among other public utility holding companies. The abandonment of stock dividends by North American Company 10 years later is a striking illustration of the way in which financial history repeats itself. Example of vicious pyramiding on stock dividends. During the boom years, periodic stock dividends were made the medium of an especially vicious pyramiding of reported profits. An operating company would pay out stock dividends with a market value more than its current earnings, and in turn, an investment trust or holding company would report these stock dividends as income in an equal amount to the market value. For example, Central States Electric Corporation which is a large holder of North American Company common stock, reported a total income in 1928, exclusive of profits on the sale of securities, of $7,188,178. Of this sum, $6,396,225 was represented by stock of North American received during the year and taken on the recipient's books at the market value for North American immediately following the date of record for each quarterly dividend. The average price at which these stock dividends were taken on the books as income was $74 per share, or $7.40 for the 10% dividend, in a year in which North American earned $4.68 per share on the average number of shares outstanding. Nevertheless, the stock market capitalized these artificial earnings of Central States Electric Corporation to arrive at its valuation of that company's shares. Market price of shares should be recognized in stock dividend payments. The New York Stock Exchange finally adopted a new listing requirement under which corporations agree not to take into their income accounts stock dividends received at a valuation greater than the amount at which such stock dividends were charged against earnings, earned surplus, or undivided profits by the issuing company in relation thereto. Although this regulation was properly conceived, it does not go to the heart of the matter. The abuses of the periodic stock dividend procedure may be readily prevented by the simple rule that stock dividends at market value must not exceed the earnings available for dividends. Declarations might well be made in the following form. A stock dividend of 5% is hereby declared. The market value of this dividend is approximately $6 per share, and it represents the capitalization of $7 per share retained in the business out of current earnings of $10 per share. Advantages of stock dividends payable in preferred stock. Dividends may be paid in preferred stock instead of common stock. The chief exemplar of this method is General Electric Company, which distributed extra dividends of 5% annually between 1922 and 1925, in addition to the regular payment of $8 in cash. These extra dividends were paid in 6% special stock, par value $10, which was in reality a preferred stock. A similar procedure was followed by S.H. Kress Company and by Hartman Corporation. The theoretical advantage of this method is that the amount of the dividend paid is clearly fixed at the effective par value of the preferred shares issued, thus obviating the complication presented by differences between book value and market value. Where the company has no senior securities or only a small amount, the issuance of preferred stock to represent reinvested earnings will not weaken the capital structure. In 1934, General Electric Company determined that its working capital position was so comfortable as to permit the retirement of the entire issue of special stock, which was accordingly redeemed in April 1935. This may be said to represent the ideal arrangement from the stockholder's standpoint in dealing with undistributed earnings. The two steps involved are as follows. 1. In prosperous years, earnings are retained for expansion or added working capital, but the stockholders receive preferred shares periodically to represent a portion thereof. 2. If subsequent business developments show that the additional capital is no longer needed, it is paid out to the stockholders through the redemption of their preferred shares. The foregoing summarized. Our conception of suitable dividend policies discussed at length in this and the preceding chapter may be summed up in the following three statements. 1. Withholding and reinvestment of a substantial part of the earnings must be clearly justified to the stockholders on the grounds of concrete benefits therefrom exceeding the value of the cash if paid to the stockholders. Such withholding should be specifically approved by the stockholders. 2. If retention of profits is in any sense a matter of necessity rather than choice, the stockholders should be advised of this fact, and the amounts involved should be designated as reserves instead of as surplus profits. 3. Earnings voluntarily retained in the business should be capitalized in good part by the periodic issuance of additional stock with current market value not exceeding such reinvested earnings. If the additional capital is subsequently found no longer to be needed in the business, it should be distributed to the shareholders against the retirement of the stock previously issued to represent it. Part 5. Analysis of the income account, the earnings factor in common stock valuation. Introduction to Part 5. The Evolution of a Value Investor by Stephen Romick. Earning a Bachelor of Science degree in education from Northwestern University is not the most traditional path to a career in finance. Nonetheless, a manager of a successful investment partnership hired me out of college in 1985 as an experiment. He said that he was tired of unlearning MBAs of their erroneous theories. It helped that he was friends with my father. At the time I received that job offer, I had already been accepted to a top law school and had intended to get both JD and MBA degrees, but I thought that a career in investing could be exciting. I lugged home a few dozen prospectuses after my first day on the job, since I didn't have a clue as to what makes something a good investment or a good business, and I had no understanding of how to read a financial statement. Hopefully, the law school that saw fit to accept me once would do so again if this experiment didn't work out. In the meantime, I committed myself to learning as much as I could about investing. Someone directed me to Benjamin Graham's The Intelligent Investor, which in turn led me to Graham and David Dodd's Security Analysis. And that, along with night classes in accounting at UCLA, became the basis for my education as an investor. Graham and Dodd introduced me to the foundations of value investing. I learned that if you were to buy a stake in a business with enough of a margin of safety, it would be hard to lose money. If the gap between the price paid and intrinsic value narrowed, then money would be made. If that business were to grow beyond expectations, you'd likely make even more. What I learned